welcome to a new RRG video for Thursday, the 18th of September. Another good day for the markets, by the way. Yesterday, Fed lowered rates. I guess that was expected. And we see a little follow through today. And what does that mean for sector rotation? And today I'd like to dive into, we'll look at sector rotation, but I'd like to dive a little bit deeper into the growth and value and the size segments, because they usually give a pretty good answer, pretty good gauge on what we can expect and what is happening in the market overall. Let me kick off with a quick look at the sector rotation, at the actual sectors. And we see the trends and the direction of the tails as continued as they have been moving over the last couple of weeks. Technology is still the highest ranked sector in terms of RS ratio, and communication services now really pushing into the leading quadrant, followed by consumer discretionary. All other sectors are now inside the lagging quadrant, with most of them actually also continuing lower on the RS ratio scale, which is a negative, and a few also still on a negative heading. So industrial still on a negative heading, materials, this is unclear, energy, and then staples, real estate, utilities, financials, and especially healthcare. They're pulling up, they're picking up on the RS momentum scale. I think that of this cluster, healthcare is now, it's the only one with a positive RRG heading. As you can see, it's moving higher on both scales, not much on the RS ratio scale, but definitely on the RS momentum scale. And that is causing the positive heading. If you look at the dispersion or the spread of these sectors on this chart, then it's very clearly to see why the S&P is going up, because technology, communication services, consumer discretionary, these three sectors together is about 55% of the market capitalization. Financials is now actually the second largest sector in terms of market capitalization. So there's been a little bit of a switch there. By the way, the page that I use for that to look at market capitalization and holdings is the official page from State Street Global Advisors, SSGA, which has the sector allocation or the fund breakdown for, in this case, SPY. And you can see that information technology is over 33%, and then financials 13.7%, consumer discretionary, services, etc., all the way down to materials, which is the smallest at 1.8%. It's just a reference, but it gives you a good clue on what's happening and why, and that for me, that's important, why that RRG is so displaced, because all that market cap is right here. And we know top right leading, that's positive. So with all that market cap concentrated on the top right-hand side, it's not strange that we see the S&P moving higher. When we switch this chart to a daily chart for the sectors, we actually see some nice confirmations. We see that technology, which, if you remember, was traveling through leading, weakening, lagging, and then improving, is now being pushed further into back into the leading quadrant. Communication services on the daily scale is the strongest sector. It's losing a little bit of momentum, but look at how high that RS ratio is. And you can see that consumer discretionary here is curling back up. So it went from leading into weakening, and it's now curling back up, and it's moving back towards leading. So the three sectors that are leading on the weekly RRG are confirming their strength on the daily. That means something. So 55% of the market cap is actually outperforming the S&P 500. That is dragging it higher. And we see all these sectors here at negative headings. Industrials, real estate, not so much. Utilities is picking up, but look at the low reading on the RS ratio scale. For the time being, I'm going to interpret and judge this as a temporary hiccup in a relative downtrend that is well underway. When we change this chart to growth and value, and we have two predefined groups for that. So We have growth and value and growth value size. I'll get to that one later. Let's start with growth and value. Let's make that a weekly. Then you see here how growth is outpacing value big time. This is a very clear message that growth is to be preferred. And we can actually make those tails a little longer because we've got plenty of space here. And you can see how that rotation brought growth to where it now is at a very high reading and value at a very low reading. So growth over value, no doubt about it. When we change this to a daily chart, then you can actually see that it is confirming that. Obviously, this is let's do this. So let's make this 30, so 25. We had 5 weeks. So 25, tail of 25 here, center the chart. You can see how during that period where growth was moving inside the leading quadrant, but losing a bit of momentum, that loss of momentum you can see magnified here. So that green tail is the growth tail, and that lowered, and then it picks up again. So it's continuing higher on the weekly RRG, and you can see that move confirmed on the daily tail of the growth value rotation. So today was actually a little bit of a hiccup here. So we need to see how that pans out. But overall, long-term picture, growth is beating value. Now we can actually divide these growth and value segments into various size segments as well. So that's large, mid, and growth. And then you'll get this type of chart. So let's look here, growth, value, and size. And this looks a little bit messed up. So we're going to put this on 5. Let's make it weeks. So 5 weeks. That becomes a little bit more clear. Now what we have here, let me bring the table to you. We got large cap growth, large cap. So US large cap, US growth, and this is done large cap growth. And we have the same for mid and small. So mid cap growth, large cap value, mid cap value, etc. So what I'd like to do is, so when I hit or highlight US growth and US value, this is the chart that we've just been looking at. So the benchmark is still the Dow Jones US index. So this is actually the growth value chart that we just looked at. When we take these out, and let me start with large cap stuff. So we got large cap growth, we got the let's do large cap, mid cap, and small cap. So now we have the size segments, large cap, mid cap, small cap. And you can see that large cap is in the leading quadrant, small cap was good, but it's rolling over, and mid cap is moving further into the lagging quadrant. So very clearly, large cap is leading. Magnificent 7, S&P 500, we know what's happening. So this chart is actually confirming that trend of outperformance for large cap stocks is still ongoing. So we had growth and we have size. And we saw that growth was good, and we see that large cap is good. Now let's take this one level lower to the value, to the value and growth segments in the size segments. So I'm going to do large cap growth, mid cap growth, large cap value, mid cap value, small cap growth, small cap value. So now I should have 6 tails. 1, 2, 3, 4, 5. Yes, 6 tails. And here it becomes even more clear. Large cap growth is inside the leading quadrant and has the highest reading. We have mid cap rotating through weakening, but still relatively strong. And then we've got small cap growth and all values, so value large, value mid, and value small on the left-hand side, either at a negative heading, moving lower on the RS ratio scale, or value small cap rotating back towards lagging inside the improving quadrant. So this is another confirmation that large cap growth is the area to be, followed by mid cap growth, but it's growth stocks all the way. Now, having said that, let's go back to the basic RRG chart and have another look at those sectors. And I did do a little bit of digging, and the general consensus for what are the growth-oriented sectors are information technology, that's XLK. Let me highlight that. Consumer discretionary, XLY, not a surprise. Communication services, XLC, not a surprise. And then healthcare is also considered to be a growth sector, and that's primarily because of biotech and pharma stocks in there. So healthcare is a bit of an outlier, but look at these three. So the growth segments of the S&P 500 are on the right-hand side and outperforming. All the other stuff is considered to be value. I'm sure there is 100% that you can debate about that, but this is kind of the general consensus that I could find. And it kind of makes sense, especially discretionary communication services and technology. So if we wrap all of this together, then we saw that in growth value, it was growth dominating. When we brought in the various size segments, it was very clearly visible that large cap growth is the area where currently the strength of the market is. And if you then look at the various sectors, you can see that the 3 out of the 4 growth sectors are on the right-hand side of the RRG, with 2 being inside leading at a strong heading and 1 at a very high RS ratio reading, but going through a correction. So I do hear all the stories about market breadth weakening and that we're climbing a wall of worry, and a lot of people trying to call the top. I've tried to do that a few times in the past, but I got cured very quickly from that illness, because I think all of technical analysis is we need to respond to what we see, and we need to respond to potential trend changes and not try to front run them. It's a nice pastime, but it's usually not very profitable. Anyway, growth stocks, especially large cap growth stocks, concentrated in these 3 sectors. And if you look at the market capitalization of these 3 sectors, these are also the largest market capitalizations among the sectors. So it all kind of makes sense and brings it all together. Let's take a look at, we can't do all the individual sector charts, but let's take a look at least these 3 here, because they make the most sense, and the S&P 500. Here is the chart of XLK. Let me blow this up a little bit. And you can see how it has absolutely cleared its overhead resistance. This week so far, we have one trading session and about 10 minutes more to go. But this is a very nice breakout. We're already trading at the higher end of the bar. So unless tomorrow is going to be a crazy day, this will be another strong week for the technology sector. The raw relative strength line has turned around and is again going to challenge that overhead resistance that dates back to 2024. When that breaks, that's usually a pretty good sign, and you will get to see a new acceleration in the relative trend as well. And the good thing is that this seems, because this is the RS ratio line is still at a very high level. It's moving lower, and the green RS momentum line is almost at 100. That's why that tail on the RRG is about to cross from leading into weakening. If this improvement of relative strength continues and we break higher, then it is very likely that this RS momentum line will turn around either at or just below 100 and start to move up again, and that will again push the RS ratio line higher. So the strong relative trend for technology remains fully intact. Let's go to communication services. So here is communication services, and look at that move. That thing is ripping. The price is continuing to move higher, 1 to 3 weeks, seriously higher moves. And we're now very clearly out of that sideways move on the relative strength line, which means that there is way more upside potential now for this relative strength line to move higher and for XLC to continue its outperformance of the S&P 500. And we see that back in the RRG lines, which are now almost over on top of each other, moving higher. That's a 45-degree angle on the RS heading, RRG heading, moving further into the leading quadrant. And then the consumer discretionary sector, wrap it up with that, blow this up as well. And you will see that we discussed this breakout a couple of times already in the past few weeks, but now that breakout is very clearly visible. And again, unless we got to see a very strange move tomorrow. This break is holding, and it's holding up well, and it's starting to pull the RS line higher, and it's pulling the RRG lines above 100 and into the leading quadrant as well. So all three of these sectors, technology, communication services, and discretionary, are breaking to new highs. They are holding up, and they're continuing to push higher, both in terms of price and relative. And let's have a look at the fourth growth sector, the healthcare sector, which is the weakest of the lot. And you can totally see why. We are still here on price. So this is becoming a valid trend line. It was only 2 points. I'm not a fan of trend lines with only 2 points. As a matter of fact, they're quite useless. But it looks as if we found a new touch point at last week's high. So this is now becoming a significant resistance level. And if I look at this chart, this could well turn into a nice double bottom. So if I put on my pink glasses or green glasses, if you wish, looking at it from a positive angle, a break above, let's say 140, which clears that horizontal level as well as the falling resistance line, would be very good, very strong for the healthcare sector, and it will definitely put the sector on track for a move to the 150 area. But what's more important is what's going to happen with that RS line, because that is a dramatic decline, which is still there, and it looks as if we're putting in a new lower high, which would mean that this is kind of an opposite move as what we just saw in consumer discretionary, I think it was, where the RS ratio was very high and RS momentum dropped and they started turning around. It looks to be similar here, but in opposite directions, where momentum is now leveling off against the 100 line, and if it turns around, it could push RS ratio even lower. The positive variant would be if we get that break higher, then this will start to turn around, but it will very likely need some time to actually show up on the chart. But after such a move, it is very possible. And if you look back in history, this is one of the, well, if not the lowest levels of RS ratio, and divergences are not really a thing in RRG analysis, but I'd like sometimes to go back and see what is the magnitude of those moves, and is it possible that there is some sort of an exhaustion taking place. And I think that here in this case, that could very well be a possibility. Anyway, the price charts, especially for tech, communication services, and discretionary, are totally confirming the rotation that we see on the RRG, and those rotations are totally confirming the concentration of outperformance in the large cap growth area. And finally, let's see what this does for the S&P chart, or SPY, what we have here. And you can see that this is continuing to move higher. There is absolutely no divergence, not in the RSI, not in the MACD. So, I mean, this can continue for quite some time. Just look at a correction like this. It's like 1 year, almost 2 years, and we're not even 1 year in. I mean, there will be some sort of a correction, but the magnitude of the correction is very debatable. And, you know, even if this thing would correct back to this breakout level, which is around 610, 613, which is pretty big decline from current levels, it is still way inside the rising trend, higher highs, higher lows. This is the last major higher high. This is the last major higher low. It's a very strong market. Let's just leave it at that. If we zoom in on the daily version, then we got this one here again, no divergence. This one here has been negated. Same here. This one here has been negated when we broke out, moving higher. Here are a little bit more intermediate support levels that you can find. But overall, the message is that this continues to be a very strong market. And my last chart that I'm going to show you is the comparison between stocks and bonds, and I use SPY and IEF for that. And you can see that this week we see a new breakout where SPY is, or basically where the ratio of stocks versus bonds is breaking to new highs and triggering a new, or unlocks new upside potential. And I think that's also a pretty important message from an asset allocation perspective, that stocks, if they weren't already high on your list, they definitely should be now, because this ratio tells you whether it's risk on or risk off. It's probably also already for a while risk on, but now it's confirmed risk on with that break above that horizontal resistance level. I'm going to leave it at this, a relatively short video, so let me know in the comments what you think about that. Need more? Need longer? Is this good? Need shorter? You prefer shorter updates or longer, more in-depth analysis, etc.? I don't know. Just trying to see what works here, and I love your input for that. Thanks for watching, and I hope to see you soon at a new video on RRG here on Stockcharts Television.